I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. The Money Game, written by Adam Smith, not to be confused with the economist Adam Smith, is a fascinating book about the world of investing and finance. Originally published in 1968, the book is still widely read and considered a classic in the field. The author takes a humorous and irreverent approach to the subject matter, which makes the book a fun read despite the potentially dry topic. The book is part memoir and part commentary on the financial world, with the author sharing his own experiences and insights along the way. One of the main themes of the book is the idea that investing is a game, and that those who understand the rules and strategies of the game can come out ahead. The author explores various aspects of the game, from the psychology of investors to the workings of the stock market. He also delves into the strategies of successful investors, and shares his own thoughts on what it takes to succeed in the world of finance. One of the most interesting aspects of the book is the way in which the author explores the psychological and emotional aspects of investing. He examines the various biases and irrationalities that can influence investors, and explains how these can be overcome in order to make more rational and effective investment decisions. He also provides insights into the way in which the stock market functions, and how investors can use this knowledge to their advantage. The book is not just aimed at professional investors or finance experts, but at anyone with an interest in the subject. The author writes in a way that is accessible and engaging, and the book is filled with anecdotes and stories that bring the subject matter to life. Whether you are a seasoned investor or just starting out, there is something to learn from this book. Overall, The Money Game is a must-read for anyone interested in finance, investing, or the workings of the stock market. The author's wit and wisdom make for a highly entertaining and informative read, and the insights he provides are as relevant today as they were when the book was first published over 50 years ago. In The Money Game, author Adam Smith argues that investing is, in many ways, like a game. And, like any game, there are rules to follow and strategies to employ if you want to succeed. He believes that those who understand the rules and strategies of investing can come out ahead in the game of finance. One of the key rules of the investing game is to focus on the long term. Smith believes that successful investors don't get bogged down in short-term fluctuations or market noise. Instead, they take a patient, disciplined approach to investing, focusing on the underlying value of the companies and assets in which they are investing. Another rule of the game, according to Smith, is to manage risk effectively. Investing always involves some level of risk, but successful investors are able to identify and manage that risk in a way that allows them to earn consistent returns over time. Smith also believes that understanding the psychology of investing is key to succeeding in the game. He argues that the stock market is driven by emotion and irrationality, as much as it is by fundamental factors like earnings and revenue growth. Successful investors are able to navigate these emotional currents and make rational decisions based on sound analysis and judgment. Finally, Smith stresses the importance of having a set of strategies and principles that guide your investing decisions. These might include things like diversification, avoiding high-risk investments, or only investing in companies that meet certain criteria. By having a clear set of rules and principles, you can make more informed, rational investment decisions that are likely to lead to long-term success. Point 2 in The Money Game refers to the idea that the stock market is driven by psychology and emotion. Author Adam Smith argues that investors are not always rational or logical in their decision-making, and that their emotions and biases can often cloud their judgment. Understanding these psychological factors is therefore essential to making successful investments. One psychological factor that Smith discusses is the fear of missing out, or FOMO. This is the feeling that you're missing out on an opportunity if you don't invest in a particular stock or asset. FOMO can lead investors to make impulsive, emotionally driven decisions that may not be based on sound analysis or judgment. Another factor is overconfidence. Smith believes that many investors are overly confident in their ability to predict the future and outsmart the market. This can lead to excessive risk-taking and overinvestment in certain stocks or sectors. Smith also discusses the role of groupthink in the stock market. When investors are all thinking and acting in the same way, it can create a kind of self-fulfilling prophecy that can drive stock prices up or down, regardless of the underlying fundamentals of the company. Understanding these and other psychological factors is key to making rational, informed investment decisions. Smith argues that successful investors are able to keep their emotions in check and make decisions based on sound analysis and judgment, rather than being swayed by market hype or sentiment. By recognizing the role that psychology plays in the stock market, investors can avoid making impulsive or irrational decisions that could hurt their returns over the long term. Point 3 in the money game refers to the fact that successful investors tend to have a set of strategies and principles that they follow. Author Adam Smith argues that there is no single right way to invest, but that the best investors have a clear set of rules and strategies that guide their decision-making. One common strategy that Smith discusses is value investing. This involves looking for companies that are undervalued by the market, and then buying their stocks in the hopes that the market will eventually recognize their true value and drive the price up. Value investors tend to focus on factors like a company's earnings, assets, and cash flow, rather than just its stock price. Another strategy that Smith discusses is growth investing. This involves looking for companies that are expected to experience strong growth in the future, and then investing in their stocks with the hopes of profiting from that growth. Growth investors tend to focus on factors like a company's revenue growth, market share, and potential for expansion. Smith also talks about the importance of diversification. By spreading your investments across different asset classes and sectors, you can reduce your overall risk and protect yourself against market volatility. Successful investors also tend to avoid putting all their eggs in one basket, and instead invest in a range of different stocks, bonds, and other assets. Finally, Smith stresses the importance of having a long-term perspective. Successful investors are able to resist the temptation to make impulsive, short-term trades based on market fluctuations or news events. Instead, they take a patient, disciplined approach to investing, focusing on the underlying value of the companies and assets in which they are investing. Overall, the strategies and principles that successful investors follow will depend on a variety of factors, including their risk tolerance, investment goals, and personal preferences. However, by having a clear set of rules and strategies in place, investors can make more informed, rational investment decisions that are likely to lead to long-term success. Point 4 in the money game refers to the fact that many investors fall prey to biases and irrationalities, which can lead to poor investment decisions. Author Adam Smith argues that understanding these biases and irrationalities is key to becoming a more successful investor. One common bias that Smith discusses is confirmation bias. This is the tendency to seek out information that confirms our existing beliefs or opinions, and to ignore information that contradicts them. In the context of investing, confirmation bias can lead investors to only seek out information that supports their investment thesis, and to ignore or downplay information that suggests they may be wrong. Another bias that Smith talks about is overconfidence. Many investors are overly confident in their ability to predict the future and outsmart the market. This can lead to excessive risk-taking and overinvestment in certain stocks or sectors, which can lead to poor investment performance. Smith also discusses the role of emotional biases, such as fear and greed, in investment decision-making. Fear can lead investors to sell their stocks during market downturns, while greed can lead them to buy stocks at the top of market bubbles. By understanding these emotional biases and learning to keep them in check, investors can make more rational, informed decisions. Finally, Smith stresses the importance of doing your own research and not relying solely on the opinions of others. Many investors make the mistake of blindly following the advice of financial pundits or stock analysts without doing their own due diligence. This can lead to poor investment decisions, as these analysts may not have the same level of understanding or insight into the companies they are recommending. Overall, by recognizing and overcoming these biases and irrationalities, investors can make more informed, rational investment decisions that are likely to lead to better long-term performance. Point 5 in the money game refers to the fact that investing is not just about making money, but also about managing risk and avoiding losses. Author Adam Smith argues that successful investors are not just focused on earning high returns, but also on preserving their capital and avoiding large losses. One key way that investors can manage risk is by diversifying their portfolio. By investing in a range of different assets, sectors, and geographies, investors can reduce their overall risk and protect themselves against market volatility. Diversification can also help to balance out the potential risks and rewards of different investments, and can provide a more stable overall return. Another way to manage risk is by focusing on the underlying fundamentals of the companies in which you are investing. Successful investors are able to identify companies that are likely to perform well over the long term, based on factors like their revenue growth, cash flow, and profitability. By focusing on the underlying fundamentals of the company, investors can reduce the risk of investing in companies that may not perform as well as expected. Smith also stresses the importance of avoiding excessive risk-taking. While it can be tempting to chase high returns or invest in hot stocks or sectors, this can also lead to large losses if those investments don't perform as expected. Successful investors are able to balance the potential rewards of a high-risk investment with the potential risks, and make informed decisions based on a careful analysis of the potential rewards and risks involved. Finally, Smith stresses the importance of having a long-term perspective when it comes to investing. Rather than getting caught up in short-term market fluctuations or news events, successful investors are able to take a patient, disciplined approach to investing, focusing on the underlying value of the companies and assets in which they are investing. Overall, managing risk and avoiding losses is a key part of successful investing. By diversifying your portfolio, focusing on the underlying fundamentals of the companies in which you are investing, avoiding excessive risk-taking, and taking a long-term perspective, you can reduce the risk of large losses and increase the likelihood of long-term success. Point 6 in the money game refers to the fact that the stock market is not always rational or efficient, and that investors can sometimes take advantage of these inefficiencies. Author Adam Smith argues that successful investors are able to identify these inefficiencies and use them to their advantage, rather than being swept up by market hype or sentiment. One example of an inefficiency in the stock market is the phenomenon of market bubbles. Bubbles occur when stock prices become detached from the underlying fundamentals of the companies in which they are invested, and instead become driven by speculation and hype. Successful investors are able to identify these bubbles and avoid investing in them, rather than getting caught up in the hype and risking large losses. Another example of an inefficiency in the stock market is the phenomenon of value investing. As mentioned earlier, value investors look for companies that are undervalued by the market, and then invest in their stocks in the hopes that the market will eventually recognize their true value and drive the price up. Value investors are able to identify companies that the market has undervalued and take advantage of these inefficiencies to earn consistent returns over the long term. Smith also discusses the role of insider trading in the stock market. While insider trading is illegal and unethical, there are still many cases where insiders use their knowledge of a company's operations or financials to profit from the stock market. Successful investors are able to identify these instances of insider trading and avoid investing in companies that may be at risk of such practices. Finally, Smith talks about the importance of being able to analyze and interpret market data in a way that is different from the rest of the market. Successful investors are able to identify trends and patterns that others may miss, and use this information to make informed investment decisions that give them an edge over the competition. Overall, the stock market is not always rational or efficient, and successful investors are able to identify and take advantage of these inefficiencies to earn consistent returns over the long term. By being able to analyze market data, identify trends and patterns, and avoid getting caught up in market hype or sentiment, investors can make more informed, rational investment decisions that are likely to lead to long-term success. Point 7 in the money game refers to the importance of discipline and patience in investing. Author Adam Smith argues that successful investors are able to resist the temptation to make impulsive, short-term trades based on market fluctuations or news events. Instead, they take a patient, disciplined approach to investing, focusing on the underlying value of the companies and assets in which they are investing. One key aspect of discipline and patience in investing is the ability to resist market noise and hype. The stock market is full of news, rumors, and speculation, and it can be tempting to react to every piece of information that comes out. Successful investors are able to filter out the noise and focus on the underlying fundamentals of the companies in which they are investing, rather than getting swept up in short-term market fluctuations. Another aspect of discipline and patience is the ability to stick to a long-term plan. Successful investors have a clear investment strategy and plan, and they stick to it even when the market is volatile or their investments aren't performing as well as expected. By taking a patient, long-term approach, investors can ride out short-term market fluctuations and focus on the potential long-term returns of their investments. Smith also stresses the importance of avoiding emotional decision-making. Fear and greed can lead investors to make impulsive, emotionally driven decisions that may not be based on sound analysis or judgment. Successful investors are able to keep their emotions in check and make decisions based on objective analysis and data, rather than being swayed by market sentiment or personal biases. Finally, Smith talks about the importance of continually learning and adapting as an investor. The stock market is constantly evolving and changing, and successful investors are able to keep up with these changes by staying informed, learning from their mistakes, and adapting their investment strategies as needed. Overall, discipline and patience are essential qualities for successful investing. By resisting market hype, sticking to a long-term plan, avoiding emotional decision-making, and continually learning and adapting, investors can make more informed, rational investment decisions that are likely to lead to long-term success. Point 8 in the money game refers to the fact that investing is not just about making money, but also about making a positive impact on the world. Author Adam Smith argues that successful investors are able to balance the pursuit of financial returns with a desire to make a positive impact on society and the environment. One way that investors can make a positive impact is by investing in socially responsible companies. These are companies that prioritize ethical and sustainable practices, such as reducing their environmental impact, treating their employees fairly, and supporting their local communities. By investing in these companies, investors can support their efforts to make a positive impact on the world, while also potentially earning strong returns. Another way that investors can make a positive impact is by investing in companies that are working to solve pressing social or environmental issues. For example, investors might invest in companies that are developing new technologies to reduce carbon emissions, or that are working to address global health crises. Smith also talks about the importance of being a responsible shareholder. Investors who own shares in companies have a voice in how those companies are run, and can use that voice to advocate for positive change. For example, investors might use their shareholder voting rights to push for greater transparency or accountability from the companies in which they are investing. Finally, Smith stresses the importance of being mindful of the potential impact of our investments. By understanding the social and environmental impact of our investments, we can make more informed, responsible investment decisions that are aligned with our values and priorities. Overall, making a positive impact on the world is an important part of successful investing. By investing in socially responsible companies, supporting efforts to solve pressing social or environmental issues, being a responsible shareholder, and being mindful of the impact of our investments, we can use our investments to create positive change in the world, while also potentially earning strong financial returns. Point 9 in the money game refers to the fact that successful investors are able to maintain a healthy perspective on their investments and avoid becoming overly emotional or attached to them. Author Adam Smith argues that it's important to be able to view your investments objectively and without emotional attachment in order to make rational, informed decisions. One way to maintain perspective on your investments is to have a clear understanding of your investment goals and priorities. By identifying your financial goals and priorities, you can develop an investment strategy that is aligned with those goals and priorities, and avoid getting caught up in short-term market fluctuations or news events that may not be relevant to your overall investment strategy. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.